Hello everyone. Am I audible? Am I audible? I hope my voice is clear. Hi Samir. Good evening. Am I audible clearly? Hello. Am I audible? Yes. So hello all. Very good evening. Today, from today onwards, we will discuss model test papers. I will discuss 6 model test papers, 2 mock test papers and 1 RTP applicable for September 2025 attempt. Many of you will go to exam without practicing these model test papers, mock test papers and RTPs. My kind request, those who are failing repeatedly in CA final direct taxation, please listen to these model test paper videos, mock test paper videos and RTP videos. I like in these videos, I will discuss with you how to solve case scenario based questions, how to solve MCQs, how to write an answer. Okay, so all those I will discuss with you, and whether sections are required to be quoted or not. In case of theory chapters, assessment procedures, appeals and revisions, GAR, how to write the answer, all those I will discuss with you in this model test paper series and mock tests and RTPs. We have already revised very important concepts in CA final direct taxation. Now I am shifting towards problematic part. Whatever that we are going to do in upcoming videos are there entirely problematic. I will discuss with you MCQs. I will also discuss case scenario based. So like please pay attention at least before going examination. Like we are doing almost 9 papers, 6 MTPs, 2 mock test papers and 1 RTP. Almost for 900 marks we are doing this revision. Okay, if you do these many problems and go to examination, you can feel very confident. Okay, first we will discuss MCQs. See, whatever this model test papers questions and whatever model test papers answers are there, I have shared with you in my group Phoenix by Uma. Okay, so there is my Telegram group Phoenix by Uma. You can join in Telegram group. Whatever the content that I am discussing with you, this entire material is available with you, available for you in Telegram group. Hi Surendra, good evening. First, Merces Swift LLP filed its return of income for assessment year 24-25, declaring total income of 18 lakhs on 2nd December 2024. On processing the return, total income determined under section 143(1)(a) was 22 lakhs. You know 143(1), right? Intimation. So he filed ITR, intimation generated. As per ITR, income is 18 lakhs. As per intimation under section 143(1), income is 22 lakhs. After disallowing claim for deduction under section 10AA on account of late filing of return of income. Thereafter, on scrutiny, assessing officer made some additions under section 40A(1)(a). 40A(1)(a) speaks about disallowance if TDS is not deducted. When you are making payment to resident, you are required to deduct TDS. If you do not deduct TDS, 30% of the expenditure is disallowed. Okay. And section 43B, and passed an assessment order under section 143.3 assessing total income 35 lakhs. So as per 143.3, how much is total income? 35 lakhs. Something happened to this. Later on, assessing officer noticed that some information is flagged for assessment year 24-25, suggesting that certain income chargeable to tax had escaped assessment. Based on said information, notice under section 148 was issued for making reassessment under section 147 after compliance with requirements stipulated under section 148A. The total income reassessed under section 147 was 142 lakhs. So income escaping assessment as per section 147, total income is 42 lakhs. My dear students, whenever you are solving case scenario based question, in examination, booklet will be given to you. In booklet, last page is rough. Keep the heading rough. In rough sheet, whenever you are studying case scenario, then write information like this in a structured way. Whenever you write information like this in a structured way, like, it becomes easy for you to tackle the MCQ. Otherwise, you will keep on checking the information in the given paragraph, and it takes lot of time for you in answering the MCQs. So first tip for answering case scenario based MCQs is writing the information in a structured manner while reading the question itself. Are you able to understand? So whenever you are doing case scenario based MCQ, write the information, plot the information in a structured way so that you can tackle the question very easily. Consider none of the additions or disallowance made in assessment or reassessment as above qualifies under section 270A6. Based on the facts of the above case scenario, choose the most appropriate answer. First question. For the purpose of answering this question alone, that means only for question 1, that intimation under section 143(1) was sent to Merces Swift LLP on 1st February 2026. Would such intimation be valid? Generally, what is time limit for issuing intimation under section 143(1)? 143(1) intimation should be issued within 9 months from end of assessment year. Are you able to understand? Here assessment year is 24-25. So assessment year 24-25, it ranges from 1st April 24 to 31st March 2025. From 31st March 2025, within 9 months. 9 months means what? On or before 31st December 2025, intimation should be given. Intimation should be given. But when intimation was given? Intimation was given on 1st February 2026. So, what happened on 1st February 2026? Intimation given. Is it valid intimation? No, it is not valid intimation. It is given after the time limit. After 31st December 2025, intimation was received. So, that intimation is time barred. Whatever the intimation given is there, it is not valid at all. Are you able to understand? So, the answer is no, since it was sent after expiry of 9 months from end of the financial year in which return was made. This is the answer. So, what is time limit for issue of intimation under 143(1)? Time limit is 9 months from end of assessment year or 9 months from end of financial year in which ITR was filed. Intimation is to be issued. Then only it is valid intimation. Otherwise, that is time barred. Okay. For the purpose of answering this question alone, assume that in case of Merces Swift LLP, certain other incomes which had escaped assessment and came to assessing officer's notice subsequently in the course of reassessment proceedings were also assessed or reassessed in the reassessment order made under section 147, in respect of which provisions of section 148A are not complied with. Examine whether action taken by assessing officer is valid while making reassessment order in respect of such incomes. Normally, assessing officer has done search and he is doing income escaping assessment. Okay, before 1st October 24 income escaping assessment, after 1st October 24 block assessment. Okay, for example, whether it is search or not, keep it aside. In income tax officer is doing income escaping assessment. Generally, as per income escaping assessment, the financial year for which notice was given, okay, during that financial year, like, they will do income escaping assessment. While doing income escaping assessment, if they come across any new income which escaped the assessment, they can consider that income also while doing the income escaping assessment. Are you able to understand? See, for example, notice was issued for 22-23 income escaping assessment. Now, note, like, what is the information the department is having? For example, building was purchased which is not disclosed in ITR 8 crores. But while doing income escaping assessment, another income, gold worth of 1 crore was purchased which also escaped assessment. That was also found out. Now, like for this also, income escaping assessment can be done without giving notice under section 148A. 148A notice is not required. Generally, before doing income escaping assessment, formality will be there. Notice under section 148A will be given. After receiving the response, they will take decision whether to do income escaping assessment or not. Whatever the procedure required before doing income escaping assessment, that procedure is not required to be followed for the same financial year if new income has escaped the assessment. For example, they are doing income escaping assessment of 22-23, and for previous year 21-22, they came to know, they found out there is one income which escaped assessment. Income escaped assessment shares 40 lakh rupees. Now, whatever the new income that is found which escaped the assessment, it belongs to another previous year. So, as it belongs to another previous year, from the beginning procedure is required to be followed. Section 148A notice is required to be given. So, the conclusion is the financial year for which income escaping assessment was done. For that financial year, if any new income comes which has escaped assessment, for that 148A procedure is not required to be followed. If any new incomes that is found which has escaped assessment, if it belongs to any earlier previous year, in that case 148A procedure is required to be followed from the beginning. Okay. So action taken by assessing officer is valid. 148A procedure is not required. Compute amount of penalty levied under section 270A of Income Tax Act 1961 at the time of assessment made under section 143(3). Assume underreporting of income is not on account of misreporting. So, if it is misreporting, 200% penalty. If it is underreporting, 50% penalty. Now, how much is how much new income was found? As per ITR, income is 18 lakhs. As per intimation, income is 22 lakhs. As per 143(3) assessment, income is 35 lakhs. Now, how much income escaped? Now, how much is increase in income? Increase in income is equal to 13 lakhs. Am I correct? 35 lakh minus 22 lakh, 13 lakhs. Now, on this 13 lakhs, we need to calculate tax amount. Now, how much is tax on 30 lakh? Tax on 13 lakhs. It is LLP na. For LLP, tax rate applicable is 30%. So, tax on 13 lakhs. 13 lakh into 30%. How much? 3,90,000 being 13 lakhs into 30%. So, because of scrutiny assessment 143(3), there is increase in income 13 lakhs. Whatever the increase in income is there, it is not misreporting of income, it is underreporting of income. As it is underreporting of income, whatever 3,90,000 is there, including HEC. To this we need to add HEC. HEC at the rate of 4. How much? 3,90,000 into 4%, 15,000. So total 4,05,000. Penalty is 50% of tax. 50% of tax means 2,02,800. So this is the penalty. Okay. So the thing is, as per intimation, whatever the income is there, as per assessment, whatever the income is there, this difference of income we need to take. The difference of income is under reporting of income. On under reporting of income, whatever the tax is there, first we will calculate tax. On such tax, 50% will be considered as penalty. If it is misreporting of income, then penalty is 200% of tax amount. Okay. Compute amount of penalty to be levied under section 270A of Income Tax Act 1961 at the time of reassessment. Under section 147, assume under reporting of income is on account of misreporting. On account of misreporting. So if it is misreporting, then penalty is 200%. Now, as per reassessment, how much is total income? As per reassessment, total income is 42 lakhs. As per 143(3) assessment, total income is 35 lakhs. Now, how much is underreported income? Underreported income is 7 lakh rupees. Now, so we will calculate tax on 7 lakh rupees. It was said that underreporting is on account of misreporting. As it is on account of misreporting, penalty is 200%. Okay, so 7 lakhs. Tax rate applicable 7 lakh into 30% plus HEC at the rate of 4%. How much? 7 lakh into 30% into 4% HEC, 2,18,400. So this is the tax amount. How much is the penalty? Penalty is 200% of tax. Why? Because it is not under reporting of income. Sorry, yeah, it is misreporting of income. As it is misreporting of income, penalty is 200%. 2,18,400 into 200%, 4,36,800. That is the clear. In continuation to question number 4, assume reassessment order made under section 147 was received on 12th December 2024 and Merces Swift LLP does not prefer appeal against such order. Can Merces Swift LLP make application for grant of immunity? Yes, as per section 270AA, if any penalty is levied, if it is under reporting, penalty is 50% of tax. If it is misreporting, penalty is 200% of tax. Whatever the normal tax and interest are there, they are paid promptly to the income tax department. Then SSE can request income tax commissioner to waive off penalty under section 270A. Okay. Now, what is the time limit for making application for waiving of the penalty? Whatever the month in which the notice is received. Now, when order was received, reassessment order was received on 12th December 2026. Okay, we need to take end of this month. What is end of month? 31st December 2026. So, within 1 month from end of month, within 1 month means on or before 31st January 2027, application should be made to Income Tax Commissioner requesting him to waive off penalty for misreporting or underreporting of income. Are you able to understand? So, what is the time limit? Yes, Swift LLP can make application. The time limit is make application for grant of immunity on or before 31st January 2027. So first answer is B, correct. Second answer D. Third answer A. Fourth answer B. Fifth answer A. No. Okay, got it. What he said here, in continuation to question number 4. Question number 4 is for misreporting of income. In case of misreporting of income, he cannot ask for waiver of penalty. Only in case of underreporting of income, whatever 50% of tax penalty is there, that can be requested. We can request income tax commissioner to waive off penalty for underreporting of income, but we cannot request income tax commissioner to waive off penalty for misreporting of income, as it is relating to misreporting of income. In case of misreporting of income, we cannot request income tax commissioner to waive off penalty. So answer is A, answer is not C. Swift LLP cannot make application for waiver of penalty. Case scenario 2. A business trust registered under SEBI regulations 2014 gives particulars of its income for previous year 24-25. Interest income from Tang Limited 10 lakhs, dividend income from Tang Limited 5 lakhs, short-term capital gains on listed shares transferred on 15th September 2024, 4 lakh rupees, short-term capital gain on sale of developmental properties 8 lakhs, interest received from investments in unlisted debentures of real estate companies 1 lakh, rental income from directly owned real estate assets 20 lakh rupees. Tang Limited is an Indian company in which business trust holds 100% of the shareholding. Tang Limited does not opt for paying taxes under section 115 BAA. So there is business trust, there is Tang Limited, and there are unit holders. Okay. Now, assume business trust has distributed entire 48 lakhs to unit holders in previous year 24-25 in the month of March 2025. Shivam is a resident holder holding 100 units and Sahaj is a non-resident holder holding 500 units. So, unit holder 1, Shivam, how many units he is holding? 100 units. Unit holder 2, he is Sahaj, he is holding 500 units. But Shivam is a resident in India, Sahaj is NR, non-resident. From the information given above, choose most appropriate answer. In respect of component of interest income from Tang Limited distributed by business trust to unit holders Shivam and Sahaj. What is being distributed? Interest income is distributed. Okay. What's happening? Tang Limited is giving interest to business trust. Whatever this interest is there, that interest is passed on to unit holders. Interest is passed on to unit holders. Whenever interest is paid, on interest rate of TDS is 5%, right? Now, no tax is deductible by business trust. This answer is wrong. Business trust is required to deduct TDS. Business trust receiving interest income. Interest income is exempt in the hands of business trust. That interest income is taxable in the hands of unit holders. So that's why business trust, before paying interest, business trust is required to deduct TDS. Option 2, tax is deductible at the rate of 5% on 20,000 distributed to Shivam and 5.2% on 1 lakh distributed to Sahaj. This is also wrong. See, whatever the interest distributed to non-resident is there, on that TDS rate is 5% plus HEC. HEC is 4%. So effective it will be 5.2%. Whatever the interest paid to resident unit holder is there, on this interest TDS rate is 10%. Okay. So the correct answer is answer C. Whenever interest income is paid by business trust to unit holder, if he is resident unit holder, TDS rate is 10%. Non-resident unit holder, TDS rate 5% plus 4% HEC, effective tax rate 5.2%. Next. In respect of short-term capital gains of 4 lakhs, on sale of listed shares of Indian companies and 8 lakhs on sale of developmental properties. The business trust is getting capital gains. Now, capital gains are taxable in the hands of business trust only. Tax rate applicable is MMR, maximum marginal rate. So, whatever the capital gain income is there, it is not taxable in the hands of unit holders. It is taxable in the hands of business trust. Can BTech students do this parallelly with their college work? A bit difficult, but you can. Now business trust is liable to pay tax at MMR. That is the hold on. Two incomes. Short-term capital gain 4 lakhs on sale of listed shares of Indian companies and 8 lakhs. So this is short-term capital gain under section 111A. Other short-term capital gain. Other short-term capital gain is taxable at MMR. Other short-term capital gain is 8 lakh rupees. This is taxable at MMR. Whatever short-term capital gain under section 111A is there, this is taxable at the rate of 20% plus HEC. So the right answer is business trust is liable to pay tax at 20.8% and an MMR respectively. This is the answer. Question number 8. Dividend component of income from Tang Limited distributed to unit holders Shivam and Sahaj. See, whenever dividend is distributed, what we need to check if SPV, special purpose vehicle, is paying taxes as per normal rates, 25% or 30%. Dividend income is exempt in the hands of business trust. It is also exempt in the hands of unit holder. If SPV, special purpose vehicle, is paying taxes under section 115 BAA, then dividend income is exempt in the hands of business trust, but it is taxable in the hands of unit holder. In the question, it was clearly said that like it did not opt 115 BAA. So special purpose vehicle is not paying taxes under 115 BAA. So what is the recourse? Now, as it is not paying taxes under 115 BAA, entire dividend income is exempt in the hands of business trust as well as in the hands of unit holder. So right answer is it is exempt in the hands of business trust since trust enjoys pass-through status and such income is taxable in the hands of unit holders. No, this is also not correct. This is also not correct. It is taxable in the hands of business trust, not correct. It is exempt in the hands of business trust as well as in the hands of unit holders. This is the correct answer. Next, question number 9. If Tang Limited exercises option under section 115 BAA, then dividend component of income from Tang Limited distributed to unit holders. So, whenever special purpose vehicle Tang Limited is paying taxes under 115 BAA, dividend income is exempt in the hands of business trust. It is taxable in the hands of unit holder. Sir, how much is taxable? In the hands of unit holder, it is taxable. In case of resident, it is taxable at normal tax rates. In case of non-resident, it is taxable at 10%. Now, it is not exempt. It is taxable. It is exempt in the hands of business trust and it is taxable. Exempt in the hands of business trust and taxable in the hands of unit holders. What is the correct option? Exempt in the hands of business trust since a trust enjoys pass-through status in respect of such income and such income is taxable in the hands of Shivam and Sahaj. What are tax rates? Dividend income. For resident, normal tax rates. For non-resident, tax rate is 10%. Interest received by business trust from investments in unlisted debentures of real estate companies and distributed to unit holders. See, from special purpose vehicle, if any interest income is received, exempt in hands of business trust, taxable in the hands of unit holder. From other sources, from others, if any interest income is received by business trust, whatever that interest income is there, that is taxable at the rate of MMR in hands of business trust only. It will not be passed on to unit holder. Only dividend income, interest income, rental income, these three incomes will be passed on to unit holder. We have clearly revised the taxation of business trust. Okay, if you are having any doubt, you can watch that revision lecture once again. Remaining incomes, they are not passed on to unit holder. Remaining incomes will be taxable in the hands of business trust only. It is interest income will be taxable at the rate of MMR. So, subject to tax in the hands of business trust at the rate of MMR. This is the correct answer. Then, question number 11. Rental component of income from real estate assets received by business trust and distributed to unit holders. Shivam and Sahaj would be rental component. Rental income is exempt in hands of business trust and it is passed on to unit holders. Rental income is taxable in the hands of unit holders. Okay. Subject to tax in the hands of unit holders. Okay. So, A is not correct. B is also not correct. C, it is taxable in the hands of unit holders. But Shivam, whether Shivam is resident or non-resident. Shivam is resident. Sahaj is non-resident. So, in the hands of Shivam, it is taxed like TDS required to be deducted at 10%. In hands of non-resident, TDS required to be deducted at rates in force. Okay. So answer is not C also, answer is D. Subject to tax in the hands of unit holders, Shivam and Sahaj. Business trust has to deduct 10% on 40,000 distributed to Shivam and rates in force on 2 lakhs distributed to Sahaj. Okay. Here only 10% is given, this is wrong. When rent is paid to resident, TDS rate is 10%. When rent is paid to non-resident, TDS rate is rates in force. So 11 answer is correct. Next, 12th question. Mr. Piyush, resident Indian, aged 77 years, gets pension of 58,000 per month from Rajasthan state government. The pension income is taxable under the head salaries. So, how much is pension income? Pension income 58,000 into 12. 58,000 into 12, 6,96,000. From salaries, you can claim standard deduction. Na? If it is default tax rates, you can claim 75,000 standard deduction. If it is optional tax rates, you will claim 50,000 standard deduction. Let's go to the last. Assume Mr. Piyush has opted out of 115 BAC. That means he is paying taxes under optional tax rates. Under optional tax rates, standard deduction is 50,000. So, how much is taxable salary? Taxable salary is equal to 6,46,000. The same is credited to his savings bank account in SBI Kota branch. In addition to that, he gets interest at the rate of 8% per annum on fixed deposit of 28 lakhs with said bank. So, interest on fixed deposit, interest on FD, 28 lakh into 8%. How much? 28 lakhs into 8%, 2,24,000. On 1st January 2025, he deposited 3 lakhs as 5-year term deposit. This is eligible for deduction under section 80C in the same account at interest rate of 8.5% per annum. So, how much is interest on term deposit? Interest on term deposit. How much he deposited? 3 lakhs. Na? 3 lakhs into 8.5%. When he deposited 1st January, that means 3 months into 3 by 12. 3 lakh into 8.5% into 3 by 12, 6,375. Next, interest on savings account 8,600. SB account 8,006. So how much is his gross total income? 6,46,000 plus 2,24,000 plus 6,375 plus 8,600, 8,84,975. From this we will claim chapter 6A deductions. See, he deposited 3 lakh in term deposit, that is eligible for deduction under section 80C. So, but maximum deduction allowed under 80C is 1,50,000 and interest on FD 2,24,000 is there. He is resident senior citizen, so he can claim deduction under section 80 TTB. You can see 77 years resident in India, so he is a resident senior citizen. He can claim deduction under 80 TTB. How much? 50,000. So how much is his taxable income? Taxable income will be 6,84,975. Now we need to calculate tax liability. He is resident senior citizen na, up to 3 lakhs there is no tax. So up to 3 lakh tax amount is nil. Greater than 3 lakh up to 5 lakh tax rate is 5%. Tax amount is 10,000. Above 5 lakh up to 10 lakh tax rate is 20%. That means 1,84,975 into 20%. How much? 184,975 into 20%, 36,995. So how much is tax? 46,995. To this we need to add HEC at the rate of 4%. 1880. So total 48,875 rounded off to 48,880. So tax liability is 48,880. And see, he is specified senior citizen. As he is specified senior citizen, bank will deduct TDS. As bank is deducting TDS, specified senior citizen is exempted from filing ITR. He is not required to file ITR. Question number 13. SNO Limited, an Indian company, paid interest on loan taken from a globally owned subsidiary PINC UK for 35 millions. SNO identified the following uncontrolled observations to arrive at this arm's length price. See, up to 5 arm's length prices we will take average. Here number is 6 greater than 5. So we need to apply only range concept. First what we need to do, we need to arrange in ascending order. Shall we arrange in ascending order? 1 5%, 2 6%, 3 8%, 4 12%, 5 14%, 6 17%. We arranged in ascending order. Then lowest is 35th percentile na. So 35th percentile is equal to 6 into 35%. How much? 6 into 35%, 2.1. It is not a whole number. So next one we need to take. So next digit is 3. So this is lower one. Now highest one is 65th percentile. 65th percentile means 6 into 65%. Upper limit is 65th percentile. 6 into 65%, 3.9. It is not whole number. You need to consider the next one, 4. 4 is 12%. So this is upper one. This is the range, 8 to 12%. That is the range. So answer is A. 8 to 12%. Median you can calculate. 14th, Smart INC Country X advanced US dollars 10 millions on 1st June 2023 to Kite Private Limited India in foreign currency. Kite Private Limited accepted the loan amount under an agreement approved by Central Government of India. The loan carries interest at the rate of 9% per annum payable in foreign currency. See, here there are two companies. Smart Inc. It is US based. Next. Another one is Kite Private Limited. It's an Indian company. Kite Private Limited accepted the loan amount under an agreement approved by Central Government of India. The loan carries interest at the rate of 9% per annum payable in foreign currency. So how much loan was given? Loan is 10 million US dollars. Okay, interest rate 9%. So how much is interest? Interest is equal to 10 million into 9%, which is 0.9 million US dollars. Now, whenever you are converting this interest into Indian rupees, you need to take exchange rate. Exchange rate is TTBR as on 31st March of financial year, as on 31st March of previous year. So as on 31st March, exchange rate is 70 rupees. So interest income is equal to 0.9 million US dollars into 70 rupees. How much? 0.9 into million means 10 lakhs. 9 lakhs into 70. 6.3 crores. That is interest in. What is the income tax liability? See here, whenever non-resident gives foreign currency loan to Indian company or business trust, this we have discussed in NR taxation revision also. Foreign currency loan given by non-resident to Indian company or business trust. If foreign currency loan is given before 30th June 2023, then whatever the interest income that is paid now on such interest income, tax rate applicable is 5%. TDS will also be deducted at the rate of 5% plus applicable surcharge plus HEC. So here how much is the tax? Tax is 5%. 6.3 crore into 5%. How much? 630 into 1 lakh into 5%. It is 31 lakh 50,000. Whether surcharge is applicable? Yes. Income is more than 1 crore na, and it is foreign company. In case of foreign company, if total income is more than 1 crore, surcharge rate applicable is 2%. Surcharge at the rate of 2%. How much? 63,000. Total 31 lakh 50,000 plus 63,000, 32 lakh 13,000. Okay. Now, to 32 lakh 13,000, we need to add HEC at the rate of 4%. How much it will be? 1 lakh 28,520. 33 lakh 41,520. So the answer is 33 lakh 41,520. Yes, Monish, what you did is correct, but you need to add surcharge and HEC. Correct. You got the right answer. STP Process Limited, an Indian company, entered into business agreement with Gale LLP of UK in September 2024 for export of goods to various countries as directed by Gale LLP. Amount of transaction between STP Process Limited and Gale LLP by way of sale of goods would be 180 crores. See, what is the transaction value? 180 crores spread over 3 financial years commencing from 1st October 24. Both parties apprehend some ambiguity. So, like one non-resident and a party in India, both are entering into one international transaction, or both are entering into one transaction. With regard to the transaction with non-resident, there is some confusion. With regard to confusion, they wanted to take advance ruling. Can they take advance ruling? See, to take advance ruling, transaction with non-resident should be more than 100 crores. Here transaction is 180 crores, which is more than 100 crores. So they can go for advance ruling. Sir, what is the fees of advance ruling? 5 lakh rupees. Okay. It can seek advance ruling since value of transaction exceeds 100 crores. Amount of fees would be 5 lakh rupees. So these are all MCQs. For MCQs, you will not find data. How answer was arrived by ICAI, you will not find anywhere. Like I started doing on my own and I am giving derivation here. So this will be helpful to you. With regard to descriptive questions, answers are available. Okay, for descriptive questions. For MCQs also answers are available. But the thing is, derivation is not available. I am trying to provide derivation through, this class. Now, shall we see questions? See, in all these questions, I will explain the adjustment. After listening to adjustments, please try to do the question on your own. Sufficient, you will get the answer. But whatever the adjustments that are there in these questions, all those adjustments we will see. Okay. First question is from PGBP. So statement of profit and loss of SJ Industries Limited engaged in production and marketing of diversified products shows a net profit of 72 lakhs for financial year ended 31st March 2025 after charge of following items. See, these items are debited to P&L account. There are some items which are credited to P&L account. We need to disallow some expenses. We need to disallow some incomes. We will read every transaction. Based on that, we will take the decision whether it is allowed or disallowed under PGBP. Okay. Depreciation as per Companies Act. It is not allowed as deduction. Depreciation as per Companies Act, it is to be disallowed. Only depreciation as per Income Tax Act is allowed as deduction. Next, interest amounting to 60,000 for short payment of advance tax. Interest on advance tax. Income tax is not allowed. Interest on income tax is not allowed. Late fees, penalty, whatever the amount paid under income tax is there, that is not allowed. That is to be disallowed. Expenditure disallowed. What we need to do? We need to add back. Next, interest and borrowing costs amounting to 9,50,000 and 7 lakh. So, not meeting the criteria for recognition as a component of cost included in cost of opening stock and closing stock. See, there is ICDS 2, valuation of inventories. As per ICDS 2, whenever any cost meets the criteria, then only it will be included in valuation of opening stock or closing stock. Here, interest cost and borrowing cost both did not meet the criteria. As they did not meet the criteria, they should not be included in calculation of value of stock. But what happened? In there is opening stock, there is closing stock. In opening stock, 9,50,000 was included, 9.5 lakh. In closing stock, how much was included? 7 lakhs was included. Now, opening stock is on debit side, debit side. So you need to disallow this. When you disallow debit side item, you need to add. And closing stock is credit side, you need to disallow 7 lakhs. Whenever credit side item is disallowed, you need to reduce 7 lakhs. So net effect is you need to add 2.5 lakhs. That is the net. Expenditure of 41,000 paid in cash comprising 22,000 directly paid to producer of dairy farming products. See, for agricultural produce purpose or for dairy farming, if you make payment, cash payment, 40A3 provisions are not applicable. Even though you make per person per day more than 10,000 rupees cash payment, still that expenditure is allowed as deduction. And 19,000 paid towards printing and stationery items to the trader. See, 19,000 cash payment was made. Total payment is disallowed. Am I correct? Total payment disallowed. 3,50,000 paid to a contractor for carrying out repair work at factory premises. TDS not deducted. Whenever payment made to resident, TDS not deducted. 30% will be disallowed under section 40A 1A. 3.5 lakh into 30%. How much? 3,50,000 into 30%, 1,05,000. 35,000 towards expenditure for earning income from transfer of carbon credits. See, whatever income from carbon credits is there, it is taxable at the rate of 10%, flat 10%. No deduction is allowed. So, it like as no deduction is allowed for, and it is taxable at flat rate, whatever the expenditure incurred for earning income from carbon credits is there, that is not allowed as deduction. This is to be disallowed. Contribution to electoral trust 3 lakh paid by way of check. Contribution to electoral trust is political party donation allowed as deduction under section 80 GGB. It is not allowed as business expenditure. This is not a business expenditure. This is not allowed as deduction. That is to be disallowed. For point 3, sir, should we show it on net basis or separately, sir? For point 3, see, you can show on net basis or you can show on gross basis. But many times student will make mistake when they show net on net basis. They do not know whether to add or whether to reduce. So I always advise students to show on separate basis. When they show on separate basis, opening stock related extra amount they will add back, closing stock related extra amount they will reduce. Okay. So no confusion will be there. Next, expenditure towards advertising charges in a brochure of a political party registered under section 29A of Representation of People Act. In political party journal, if you give any advertisement, whatever those advertisement expenses are there, they are completely disallowed. They are not allowed as deduction. But they are allowed as deduction under section 80 GGB. Okay. Next, interest on term loan obtained from cooperative bank. Here 43B is applicable. Whenever you obtain loan from cooperative bank, you need to pay interest. For payment of such interest, 43B is applicable. If you pay in current year, allowed as deduction in current year. If you pay next year, in next year if you pay before ITR due date, allowed as deduction in current year. Otherwise, allowed as deduction on cash basis. Here, not paid before ITR due date. As it is not paid, it is not allowed as deduction. That is to be disallowed. Actual contribution to pension scheme of employees 1,90,000. See, if any amount is contributed to pension scheme, 14% of salary will be allowed as deduction. Okay. Here salary means basic plus DA. Basic plus DA. That information is given in note points. Where that information was given, it is given somewhere. We will come back to this point. Okay. Unrealized rent 3,80,000 pertaining to financial year 2021, 21, 22 recovered during the year. Recovery of unrealized rent, it is taxable under income from house property. However, 30% deduction is allowed. So that means how much is taxable? Taxable is equal to 3,80,000 minus 30%. 2,66,000 is taxable. See, it is taxable under income from house property. Na? Should it be credited to P&L account? No, it should not be credited to P&L account. So, this is to be disallowed. It will be disallowed from PGBP and added in income from house property. Income is disallowed. What is the tax treatment? We will reduce. Whenever expenditure is disallowed, add back. Whenever income is disallowed, reduce. Next, Dividend from specified foreign company. This is taxable under IFOS. Now, it should not be credited to P&L account, but it is credited to P&L account. Now, while calculating PGBP income, we will disallow it. Profit of 3 lakhs received from hedging contract entered into for meeting out loss in foreign currency payments towards an imported printing machinery valued at 95 lakhs installed on 15th December. See, with regard to purchase of capital asset, with regard to purchase of plant and machinery, if there is any change in foreign currency, because of change in foreign currency or because of forward contract, if there is any gain or loss, that gain or loss will be added or reduced from block of assets as per section 43A. So this also should not be credited to P&L account. This will be adjusted with block of assets. So it will be disallowed. Next, interest from bank on fixed deposits net of TDS. See, 1,35,000 is net of TDS. We need to gross up. How much? 90 into 100. How much it will be? 1,35,000 divided by 90 into 100. 1,50,000 is taxable under IFOS. Now, this is to be disallowed. Disallowed means what? While we are calculating PGBP income, we will reduce it. Okay. See, in total, in PGBP problem, important thing is you will do adjustments. You will disallow expenses, you will disallow incomes. At the same time, whatever the incomes that are disallowed are there, they should be included in respective heads of income. Here, income from house property you will disallow. While calculating total income, you should calculate income from house property. You also need to calculate income from other sources. You should not make that mistake. So, like whenever you are calculating total income, always come back to the question, check the adjustments. Whatever income from house property, income from other sources that you have written are there, note them and do the answer. Okay. Next, additional information. Depreciation as per income tax rules. This is allowed as deduction. Expenditure pertaining to previous financial year allowed on due basis but paid in current financial year in cash. See, in earlier year, that expenditure was claimed as deduction on accrual basis. In current year, it is paid, but it is paid in cash. So in earlier year, he claimed deduction. In current year, more than 10,000, he is making cash payment. So whatever the expenditure that is allowed in earlier is there, that is disallowed in current year, it will be recognized as income in current previous year. Audit fees for 23-24 75,000. TDS deducted but not paid in relevant previous year. However, TDS was paid on 31st December. 31st December means what? After ITR due date. So in 23-24, it is not allowed as deduction, but it is allowed as deduction in 24-25. Are you able to understand? So that expenditure is pertaining to 23-24. In 23-24, TDS deducted, but TDS is not paid before ITR due date. So disallowed in 23-24, it is paid in 24-25. So allowed as deduction in 24-25. Income from transfer of carbon credits, I think 115 BBF. Okay, taxable at the rate of 10% flat. No deduction is allowed. Yeah, eligible salary and dearness allowance for the pension scheme is 10 lakh rupees. Let's come back to this concept. 10 lakh into 14%, how much? 1,40,000. How much is employer contribution? 1,90,000 na. Now, employer contribution 1,90,000. Out of 1,90,000, how much is 14% of salary? 14% of salary is 1,40,000. That is allowed as reduction. Whatever balance 50,000 is there, that is to be disallowed. Okay. Will the question specify whether it is before or after TDS? Whenever needed, sir, because in some cases I observed that it is not specified, especially for interest or dividend income. See, generally they will specify. If they do not specify, you write the assumption. It has been assumed that it is net of TDS amount is given in the question, and you have considered gross amount in calculation of income from other sources. So when you write your assumption, you are on safer side, marks will be allotted to you. If he gives in the question, no problem at all. Next, shall we discuss question number 2? See, all adjustments were discussed. You please go through the answer. You will understand. G Limited, a domestic company, provides following information of its statement of P&L for the year ended 31st March 2025. It earned a profit of 20 lakhs after debiting or crediting the below items. Now, in this question, we need to do math calculation, compute minimum alternate tax under section 115 JB. While calculating MAT, provision for loss of subsidiary, that is to be added back. Next, provision for doubtful debts. Provision for bad debts are also not allowed as deduction. That is also required to be added back. Next, provision for income tax, that will also be added. Provision for gratuity based on actuarial valuation, that is allowed as deduction. See, in PGBP, any provision will be disallowed. But while calculating MAT, while calculating book profits, if any provision is created based on actuarial valuation, it is allowed, it is not to be disallowed. Okay. Next, depreciation as per Companies Act, that needs to be added. See, Companies Act total depreciation we will add back. Companies Act total depreciation we will reduce other than depreciation on revalued assets. Okay. Next, interest to financial institution unpaid before ITR. See, if it is unpaid, it is disallowed under PGBP. But while calculating book profits, you need not disallow. Next, penalty for infraction of law. This is also disallowed under PGBP, but this is allowed while calculating book profits. Items credited to statement of P&L. Profit from unit established in 2019 in special economic zone. For that, MAT provisions are applicable. You need not disallow. Share of income of an AOP as a member. See, AOP already paid tax. Again, whatever the share of income received from AOP is there, again on that MAT is not applicable. As MAT is not applicable, we will reduce while calculating book profits. Income from units of UTI. Next, provision for income tax includes 55,000 of interest payable on income tax. Even interest on income tax is also to be disallowed while calculating book profits. Depreciation includes 2,50,000 on account of revaluation. So what will we do? Depreciation 4,60,000 we will add. But 4,60,000 minus 2,50,000, 2.5 lakhs. How much? 2,10,000 is to be reduced. Okay, so net effect 4,60,000 minus 2,10,000. Net effect is 2.5. Next, depreciation as per income tax rules. See, while calculating book profit, depreciation as per income tax is irrelevant. That is not required. Brought forward loss of 11 lakh include unabsorbed depreciation 5 lakhs. So, unabsorbed depreciation 5 lakh. Brought forward losses 6 lakhs. Out of these two, whichever is lower means you will consider 5 lakhs. Okay. So you will reduce 5 lakhs while calculating book profits. AOP of which company is a member has paid taxes at MMR, maximum marginal rate. That's why share of income from AOP that is to be reduced. So I explained all the adjustments. You can go through the calculation. Next, B. Compute total income and net tax liability of Mr. Nitin, an individual resident in India, aged 25 years, for assessment year 25-26 from following information furnished by him for the year ended 31st March 2025. Mr. Nitin earned royalty income 18 lakhs from PTINC of country X. for writing articles in journals and newspapers for the year ended. See, royalty income received for writing articles in journals. That royalty income is not eligible for deduction under 80QQB. Okay. Sir, do we have to write detailed notes for other than PGBP questions? See, for other than PGBP questions, you need not write detailed notes, but whenever you are doing the adjustment, there itself in bracket write the point, write the provision in a simpler way, that is sufficient. Here, I can tell you, share of income from of an AOP as a member, you will reduce it. In brackets, you can write as it is already taxable in the hands of AOP. Again, MAT provisions are not applicable. In that way, if you can write justification, sufficient. For MAT provisions, for book profit calculation, to the extent possible, wherever you disallow it and wherever you reduce it, there itself you write the adjustment. Okay, there itself you write the justification, sufficient. And see, here this question is relating to DTAA. Whenever there is no double taxation avoidance agreement, then you have to write some points. Okay, whenever you have income from foreign country and with that foreign country India is not having DTAA, then like you are required to relief is allowed under section 91. 18 lakhs from PTINC of country X for writing articles. However, he has received only 13.6 lakhs during previous year 24-25 and balance is outstanding as on 31st March 24. He maintains cash system of accounting. See, under PGBP, accrual basis or cash basis as may be followed by the SSC. Here SSC is following cash basis. So we will calculate income based on cash basis only. Okay. He also earned rental income 3.6 lakhs from a house situated in country X. Municipal taxes paid in respect of house amounted to 12,000, which is not allowed as deduction in country X. No DTAA exists between India and country X. In country X, all incomes are chargeable at tax of 15%. So what will we do? We will calculate the income, then we will calculate the tax liability. So what are all the incomes that he is having? Royalty income 13.6 lakhs, correct? So royalty income 13.6 lakhs, 13 lakh 60,000. Other than royalty, income from house property. How much is gross annual value? He did not give income from house property. Rental income means gross annual value 3,60,000. Municipal taxes are not allowed in foreign country, but as per Indian income tax law, municipal taxes are allowed na. So we will claim municipal taxes as deduction. How much are municipal taxes? 12,000. 3,60,000 minus 12,000. 3,48,000. From this claim standard deduction. 1,04,400. Now, how much is income from house property? 2,43,000. How much is total income? 13,60,000 plus 2,43,600. Let's check the answer. So 2,43,600, 13,60,000, and he is also having dividend from Indian company 5,50,000. So total income is 21,53,600. Okay. So how much is dividend income that he is having? He is having dividend income of 5,50,000. On 1st April 2024, he took an education loan for his son. See, whenever education loan is taken, interest on education loan is allowed as deduction under section 80E. Okay. So, dividend income 5,50,000, gross total income 13,60,000 plus 243,600 plus 5,50,000, 21,53,600. From this, you can claim chapter 6A deductions. You can claim deduction under section 80E. How much? Only interest component. Interest component is 36,000. So how much is taxable income? 21,17,600. So first, what is step 1? We will calculate tax on total income, both Indian income and foreign income. So he has opted out of default tax regime. That means he is paying taxes under optional tax rates. Okay. Now, under optional tax rates, what is tax liability? Up to 2.5 lakh, tax amount is nil. Correct? Zero. Greater than 2.5 lakh up to 5 lakh, tax rate is 5%, tax amount is 12,500. Above 5 lakh up to 10 lakh, tax rate is 20%, tax amount is 1 lakh. Above 10 lakh, tax rate applicable is 30%. So 11 lakh 17,600 into 30%. How much? 3,35,280. So how much is total tax? 4,47,780. To this we need to add HEC at the rate of 4%. 17,911. 4,65,691. So this is final tax. This is step 1, tax on total income, both Indian income as well as foreign income. Now we will calculate average tax rate in India. How much? 465,691 divided by 21,17,600 into 100. Average tax rate in India 22%. Average tax rate in country X 15%. Whichever is lower means we will consider 15%. Now, how much is doubly taxed income? Doubly taxed income is royalty income and income from house property. How much? Doubly taxed income 13,60,000 plus 243,600. 16,03,600. 16,03,600 into 15%. Much? 2,40,540. So that is relief under section 91. How much is actual tax? 465,691. From that we will reduce relief. So how much is final tax liability? 2,25,151. That is final tax liability, which is rounded off to 225,150. So did you understand question number 2? Everybody? Next, question number 3. Come join live, everybody. Consistently we will solve all these MTPs. Eventually you will pass in the exam. All this knowledge is going to create value addition to you, benefit to you. So shall we do question number 3? Balance sheet of Mercers SN Charitable Trust as on 31st January 2025 and its other information is given here under. Capital fund 800 lakhs, sundry creditors 335 lakhs, Land purchased in the year 2009, land purchased in the year 2015, balance in current account, balance in FDs, cash in hand, TDS. Application for registration was made on 15th April 2012. That means before 15th April 2012, trust is an AOP. Okay, so it paid taxes normally, but 12AA or 12AB benefit was received on or after 15th April 2012. So why I am saying this now? Let us see further. Uh, Registration of 12AB was granted on 1st July 2012 to Merces SN Charitable Trust. However, registration was cancelled on 31st January 2025. Whenever trust registration is cancelled, trust is required to pay exit tax on accreted income. While calculating accreted income, if any asset is purchased before registration under section 12AB, that is to be excluded. Are you able to understand? Here you can see land is purchased in 2009. That means land is purchased before trust registration under section 12AB. So that land is to be excluded while calculating the accreted income. Are you able to understand? An appeal was preferred against the order of cancellation, which was also dismissed by appellate authorities. Order confirming the cancellation was received on 31st March 2025. Additional information: stamp duty value of the land purchased in 2009. On this, this should not be considered in calculation of accreted income because this land is purchased before trust registration. So if any asset is purchased before trust registration, that is to be excluded while calculating the accreted income. Next, land and building purchased in 2015. 2015 means after 2012 na. That means after trust registration. So this will be considered in calculation of accreted income. What you will consider, fair market value or stamp duty value? Out of fair market value, stamp duty value, whichever is higher is there, that will be considered in calculation of accreted income. So 1000 lakhs, 1050 lakhs, whichever is higher means 1050 lakhs, that will be considered in calculation of accreted income. Highest and lowest value per share of Merces XP Limited traded on 31st January 2025 was 1099, 1051. So whenever you are whenever you are valuing listed shares, you need to consider average rate, average price. Average price as on the date of cancellation of registration. When registration was cancelled 31st January 2025. So 1099 plus 1051 divided by 2. How much? 1075. Into number of shares. How many shares are there? 2000 shares. 21.5 lakhs. Sundry creditors include 30 lakhs provided on estimated basis. It is not actual, it is estimated basis. So 30 lakhs should be excluded in calculation of creditors. It is not correct. Okay. Based on above information, calculate exit tax. Easy, you can calculate exit tax. So 100 lakhs should not be considered. For land and building, you will consider stamp duty value or fair market value, whichever is higher. Whichever is higher means 1050 lakhs. Next, for this, you will consider 21.5 lakhs. We have already done the calculation. Okay. Next, current account, this will be considered 10 lakhs. Fixed deposit, like that itself you need to take. There is no concept of fair market value for fixed deposit. Cash in hand 3.5 lakhs. TDS, this is not income now. It is tax payable to government. So how much is value of total assets? 1050 plus 21.5 plus 10 plus 200 plus 3.5. 1285. Liabilities, you will take sundry creditors. From sundry creditors also you need to exclude 30 lakhs because they are fictional, they are not actual. So 305 lakhs. So 1285 lakhs minus 305 lakhs, how much? 980 lakhs. So accreted income is equal to 980 lakhs. On accreted income, tax is required to be paid at MMR, maximum marginal rate. In case 34.944%, which is 3 crore 42 lakh 45,120. Let us check whether answer is correct or not. Three crore 42 lakh 45,000. So did you understand this problem, everybody? Shall we do the next one? STP Limited is an Indian company engaged in manufacturing of supreme quality cotton bed sheets. It has borrowing of 60 crores by way of loan as on 1st April 2024. Fix Limited of Canada imported 4 lakh bed sheets. So there are two companies, STP Limited, Indian company. Next there is Fix Limited, Canada company, Canada based company. Okay. Fix Limited of Canada imported 4 lakh bed sheets from STP Limited for resale in Canada at the rate of 2,200 per unit. The STP Limited is there na, it exported to Canada at the rate of rupees 2,200 per unit. For outsider, it sells for rupees 2,300 per unit. Okay. STP Limited received a bank guarantee on 1st April 2024 for availing cash credit limit of 9 crore rupees, for which Fix Limited was guarantor. The terms of trade, see, STP Limited total borrowings 60 crores. Out of 60 crores, how much is guaranteed? Out of 60 crore rupees, 9 crores is guaranteed by Fix Limited. 9 crores is guaranteed. 9 crores means what? It is greater than 10%. Na? So we can tell Fix Limited and STP Limited as associated enterprises. So the transaction is happening between associated enterprise and it is international transaction because one of the party is non-resident. Whenever it is international transaction, transfer pricing provisions are applicable. Okay. The terms of trade for other dealers was to make payment within 1 month from date of sale of goods by STP Limited, whereas for Fix Limited, credit period allowed was 3 months from date of sale of goods. The cost of capital was 12% per annum. See, for outsiders, credit period is 1 month. For Fix Limited, credit period is 3 months. Generally, if more credit period is given, more price will be charged because interest cost will also be added to the actual cost of the product. Correct? So generally for outsiders, it is given for 1 month credit. However, for related party, associated enterprise, it is given for 3 months credit. So cost of capital is 12%. So we need to calculate arm's length price. Shall we calculate arm's length price? In these two, which is unbiased, whatever the transaction with associated enterprise is there, it is biased. But whatever the transaction with outsider is there, it is unbiased, right? So that we will take as base. So sale price 2,300 rupees per unit. Now there is functional difference. For outsider 1 month credit, for associated enterprise 3 months credit. For outsider also, if 3 months credit is given, generally 1 month credit is given. For Outsider also, if 3 months credit is given, how much extra credit? Extra credit for 2 months. For extra credit for 2 months, interest cost will be included in price na. How much will be interest cost? 2300 into 12% into 2 by 12. How much? 2300 into 12% into 2 by 12, 46. So 2346 is arm's length price. But how much is actual price? He exported actually for 2200 rupees. Now how much is difference? Difference 2346 minus 2200, 146. Now whatever difference 146 is there, that is for one bed sheet. How many bed sheets are sold? 4 lakhs. So 146 into 4 lakhs, how much? 584 lakhs. That is the income that is required to be added. Are you able to understand? So primary adjustment is 584 lakhs. Next. Shall we do question number 4? 4, 5, 6 simple only. They will not take much time. Shall we do question number 4? I know you are exhausted. Still, you have to give your 100%. The moment you feel so much tired, the moment you wanted to give up, that is exactly the point where you need to study again. You need to study for some more time and you need to clear. Then only you can clear. Okay. Anyhow, we need to do the hard work. Let us do all the hard work for one attempt and clear. Okay. Just give me 1 second. అమ్మా నాన్న ఫోన్ చేస్తున్నాడు చూడు. Examine whether TDS provisions are attracted in following case. Am I audible? Hello. Kite and Co. LLP withdrew from its bank 68 lakhs in cash for buying agricultural produce from farmers. Agricultural is being raw material required for manufacture of finished products and 58 lakhs for other business purposes. There is one section, section 194N. As per 194N, if you withdraw more than 1 crore rupees, then TDS will be deducted by bank. Okay. Now 68 lakhs plus 58 lakhs. How much is total? 126 lakhs. See, whether it is withdrawn for agriculture purpose or whether it is withdrawn for business purpose, not relevant. For any purpose, if you withdraw cash more than 1 crore rupees, TDS will be deducted at the rate of 2% in excess of 1 crore. Now, how much is in excess of 1 crore? 26 lakhs. On 26 lakhs, 2% TDS will be deducted. 26 lakhs into 2%, 52,000. Next, interest of 98,000 on capital gain bonds issued by Power Finance Corporation to Mr. Ajay, a non-resident individual. If he is resident individual, TDS is not required to be deducted under section 194A. As he is non-resident individual, 194A is not applicable. In this case, section 195 is applicable. Are you able to understand? So TDS will be deducted as per section 195 at normal tax rate. Next, tax assessment of Mr. Pramod was completed on 25th December 2024 and the tax due was determined 115 lakhs. The SSC has following: bank fixed deposit with Canara Bank 22 lakhs, receivable from T and Co Limited 27 lakhs. He gifted a land to his son aged 35 years, 5 years ago, whose present market value is 28 lakhs. He gifted a diamond necklace to his son's wife, evidenced by a gift deed dated 5th October 2021. Discuss against which of the movable or immovable properties. Actually, this question is from recovery of tax chapter. Okay. So tax recovery officer, he will recover tax from, first what he will prepare? He will prepare tax recovery certificate and he will recover tax from SSC. While recovering tax from SSC, he can recover tax from SSC movable property and SSC immovable property. If SSC gives any gift to his minor son or his spouse, even assets gifted to minor son and spouses are there, they will also be treated as they will also be deemed as SSC property, and whatever those assets are there, they will also be recovered. Here SSC is Mr. Pramod. Mr. Pramod movable property, immovable property will be recovered by income tax officer. So Mr. Pramod bank fixed deposit, it will be recovered. Receivables 27 lakhs, they will be recovered. They will be recovered. And 5 years ago, he gifted to his son. Whatever the land gifted to son, son is major son, 35 years. So this cannot be recovered. Cannot be recovered. And diamond necklace, how much? Diamond necklace gifted to son's wife, daughter-in-law. Even if it is gifted to daughter-in-law, that will be deemed as SSC property and it will be recovered. Are you able to understand? So even this diamond necklace will also be recovered. Very simple. Tax recovery officer, he will recover movable and immovable assets of SSC. He will also recover if any assets gifted by SSC to minor son or wife or son's wife and grandchildren. Okay. So whatever the assets gifted to these people are there, it will be deemed as all these assets also belong to SSC and they will be recovered by tax recovery officer. XYZ Limited provides you P&L account for financial year 23-24 and financial year 24-25. There is one concept, limitation of interest on benefit. In transfer pricing, we have studied whenever you are paying interest to associated enterprise, 100% of interest to associated enterprise is not allowed. Maximum interest allowed is actual interest paid to associated enterprise or 30% of EBI TDA, earnings before interest, tax, depreciation and amortization. Whichever is lower will be allowed as deduction. So in 23-24, how much is gross profit? 2030 lakhs, correct? First, we need to calculate earnings before interest, tax, depreciation and amortization. So, interest, depreciation, income tax, employee benefit expense we need to reduce. So, gross profit is 2030 lakhs. From that, we need to reduce employee benefit expenditure. How much? 390 lakhs. Thereby, you are going to arrive at earnings before interest, tax, depreciation and amortization. How much it will be? 1640 lakhs. Now, interest allowed is equal to actual interest to associated enterprise or 30% of EBI TDA, whichever is lower. How much is actual interest to associated enterprise? Actual interest to associated enterprise is 562 lakhs. So 562 lakhs or 1640 into 30%, whichever is lower. That means 562 lakhs or 1640 into 30%, 492 lakhs, whichever is low. That means 492 lakhs is allowed as deduction. So very simple. Out of 562 lakhs, 492 lakhs allowed. How much is balance? 70 lakhs. That 70 lakhs is to be disallowed in current previous year. But this can be carried forward and set off in subsequent years for 8 years. Are you able to understand? That can be carried forward and set off in subsequent 8 assessments. Next, shall we do same calculation for next year 24-25? So in 24-25, 1780, 1780 lakhs minus employee benefit expenditure 402 lakhs. How much is earnings before interest, tax, depreciation and amortization? 1780 minus 402, 1378 lakhs. Now, how much is allowed? Allowed is equal to actual interest 389 lakhs or 30% of EBI TDA, 1378 lakhs into 30%, which is 413.4 lakhs, whichever is lower. So total 389 lakhs is allowed as deduction. 389 lakhs allowed. Now there is some space now. How much is allowed? 413.4 lakhs is allowed. Correct? 413.4 lakhs is allowed. So in current year, we have limit up to 413.4 lakhs, but actual interest we paid is 389 lakhs. But brought forward interest expenditure is there. How much is brought forward interest expenditure? Brought forward interest expenditure is 70 lakhs. Now, can we claim 70 lakhs here? No, not possible. How much is possible? 413.4 minus 389. 24.4 lakhs we can claim as deduction in current year. So in current year, we will claim total 413.4 lakhs as deduction. How much is brought forward? Brought forward interest is 70 lakhs. Out of 70 lakhs, we have set off in 24-25. How much we have set off? See, within the limit, we have set off 24.4 lakhs. How much is balance? Balance is 70 lakhs minus 24.4, 45.6 lakhs. That will be carried forward for next 7 years. Okay, did you understand? Now, shall we do 5 and 6? Question number 5. See, 3 cases are given. For out of these 3 cases, for any 2 cases, you need to write the answer. Okay, what is the provision, analysis and conclusion? In that way, you need to write the answer. He only gave what is the issue involved, what is the provision applicable, what is the analysis and conclusion. We need to write. Now, first, arm's length price determined by tribunal, which is the final fact finding authority, is final and cannot be subject matter of scrutiny by High Court, as it does not give rise to a substantial question of law. Accordingly, in an appeal under section 260A, High Court is precluded from examining the correctness of determination of arm's length price. Examine the correctness of this statement with reference to a recent Supreme Court ruling. See, generally with regard to question of fact, maximum you can go up to ITAT. With regard to question of law, you can go up to High Court, you can also go up to Supreme Court. With regard to calculation of arm's length price, already tribunal has given order. Now, SSC wanted to go to High Court. But assessing officer is saying SSC cannot go to High Court because already arm's length price is determined by tribunal. Now, the question is determination of arm's length price. Is it question of law or question of fact? If it is question of fact, up to tribunal only allowed. If it is question of law, SSC can go up to Supreme Court. The thing is determination of arm's length price, whether it is question of law or not, that depends upon various factors. Okay. So if tribunal also computed arm's length price as per provisions of the act, fine. If tribunal did not compute arm's length price as per provisions of the act, then provision can be challenged at next level, High Court. Are you able to understand? So whatever the contention of assessing officer that SSC cannot go to High Court with regard to determination of arm's length price is there, that is not correct. SSC, if tribunal did not calculate arm's length price as per provisions of act, then SSC can challenge the provision of Income Tax Act at High Court level also. Are you able to understand? So we will write the issue involved. Issue involved is determination of arm's length price, whether it is question of law or not. Okay, provision. If it is question of law, SSC can go up to High Court or Supreme Court. If it is question of fact, SSC can go only up to Income Tax Appellate Tribunal. Now, if Income Tax Appellate Tribunal did not do calculation as per arm's length price given as per provisions of Income Tax Act, or if there is any confusion with regard to provisions of Income Tax Act with regard to calculation of arm's length price, then those provisions can be challenged at next level as question of law at High Court or Supreme Court. Okay, so you will write the description. Ultimately, you are going to write the conclusion. Whatever the action taken by assessing officer is there, that is not correct. Tangram Limited entered into a contract for purchase of patented process with Merces-Inc, a non-resident company based in country X. It filed application under section 195(2) before assessing officer to make payment to non-resident company for purchase of patented process without deducting tax at source. The SSC Tangram Limited contended that said non-resident company had no PE in India, and in terms of DTWA between India and country X, no tax was to be deducted on same. Assessing officer rejected SSC's application on ground that consideration for patented process constituted royalty under section 916 and was liable to be taxed in India. Accordingly, SSC was directed to deduct tax at 10%. On appeal, Commissioner passed on the order in favor of the SSC. On further appeal, Tribunal upheld the order passed by assessing officer on the grounds that payments made for purchase of patented processes were in the nature of royalty and tax deducted on such payment. SSC company filed a miscellaneous application for rectification under section 254 before the tribunal. The SSC has also filed appeal before the High Court. Tribunal allowed said application in excess of his powers under 254(2) and reheard the entire appeal. See, whatever this is there, all this is bakwas. All this is bakwas. ICAI gave this much content to waste your time. The real content is there in this paragraph. I will tell you the story. A case was filed in CIT appeals. Decision came in favor of SSC. Then department challenged in Income Tax Appellate Tribunal. Income Tax Appellate Tribunal gave decision in favor of the Income Tax Department. Now, it can be further challenged in High Court now, but SSC did not challenge it High Court. SSC raised rectification petition. That means SSC under section 254, he requested Income Tax Appellate Tribunal for rectification of mistake. Income Tax Appellate Tribunal has power to rectify its mistake, but Income Tax Appellate Tribunal does not have power to review its decision. Okay, so if Income Tax Appellate Tribunal passes any order, that order cannot be reviewed by Income Tax Appellate Tribunal. Power to review is available only with High Court or Supreme Court. Are you able to understand? So here Income Tax Appellate Tribunal, whoever Income Tax Appellate Tribunal is there, Income Tax Appellate Tribunal passed the order and it also reheard. Reheard option, reheard benefit is not available to Income Tax Appellate Tribunal. Once order is passed, it is final. It cannot be reviewed by Income Tax Appellate Tribunal. Here Income Tax Appellate Tribunal reviewed its order. Whether is it correct? It is not correct. So provision is as per provisions of Income Tax Act. You need not write section number. You can write as per provisions of Income Tax Act. Like Income Tax Appellate Tribunal has power to rectify its mistake, but it does not have power to review the order passed by ITAT. In the given question, ITAT has reviewed its order. Whatever the order review done by ITAT is there, that is not correct. You will write the conclusion. So simple, in 3 lines you can write. Provision, as per provisions of Income Tax Act 1961, ITAT has power to rectify its mistake. It does not have power to review its order. Condition 2, ITAT, whoever ITAT is there, ITAT, condition 2, in the given case, ITAT has reviewed its order. Conclusion, ITAT is not correct. Whatever the action done by Income Tax Appellate Tribunal by reviewing the order passed by it, that is not correct. You will write that answer. Okay. On 31st December 2024, a search under section 132 was conducted in business and residential premises of Mr. Yatin, and some gold bars were seized from the locker. Mr. Yatin voluntarily disclosed 12.5 crores of income during the course of search. Later on, he filed an application for sale of gold bars weighing 5 kgs for adjustment towards tax liability even before completion of assessment. See, in search concept, I have already explained to you during the revision of assessment procedures. Whenever search is conducted, department will seize the assets, department will take the assets. Assess whatever the assets that are disclosed are there. SSE can get back those assets only after completion of assessment. Here assessment is not completed. Before completion of assessment only, SSE made application to assessing officer. Is it correct? It is not correct. SSE can make application for disclosed assets only after completion of assessment. Okay. Next, describe 3-type structure of transfer pricing documentation mandated by BEPS. This is theory question. You can read on your own. There is nothing that I can explain with regard to this. Next, question number, last question. TMP Limited is engaged in transportation of building material and transportation of goods to contractors. It made payment for hiring dumpers for this purpose. The company has not deducted TCS on the ground that since the payment was made for transportation of goods and not renting out machinery and equipment, such payment could not be termed as rent paid for use of machinery under section 194I, and hence no TDS was deducted. The tax auditor is, however, of the view that transactions being in the nature of contract for shifting of goods from one place to another would be covered under works contract, thereby attracting the provisions of section 194C. See, normally client is there, tax auditor is there. In between client and tax auditor, opinion differences will come. Client will tell TDS is not required to be deducted. Tax auditor will tell TDS is required to be deducted. So, if tax auditor varies from opinion of the client, tax auditor should write observation in the tax audit report. Now, if I vary with client, if my point of view is TDS is required to be deducted, client point of view is TDS is not required to be deducted, what I will do, I will write my objection in my tax audit report. TDS is required to be deducted, but the TDS was not deducted by SSC. After writing that report, there will be 3CD. Tax auditor is required to submit 3CD. In that 3CD, I will disallow 30% of the expenditure under section 40A 1A. Are you able to understand? So if there is dispute or difference between SSC and tax auditor, and tax auditor feels that TDS is required to be deducted, then he need to comment in his tax audit report, and accordingly adjustment is also required to be given in form 3CD. Okay. Next, SD Limited, a pharmaceutical company incorporated in year 2001, purchased a new plant and machinery for 12 lakhs on 1st April 2024. Total income of the company for assessment year 25-26 before allowing additional depreciation in respect of new plant and machinery is 22 lakhs. SD Limited has not opted for concessional tax rates. As per regular tax rates, we need to calculate tax liability. Shall we calculate? So, uh, income, how much is income? 22 lakhs. But this income is before reducing additional depreciation. So, we need to reduce additional depreciation. 22 lakhs, additional depreciation is 20%. 12 lakhs into 20%, 2.4 lakhs. After reducing additional depreciation, how much is there? 19.6 lakhs. On 19.6 lakhs, turnover during 22-23 is 338 crores, less than 400 crores. So tax rate applicable is 25% plus 4% HEC. 25 plus 4%, 26%, 19 lakh 60,000, 26%, 5 lakh 9,000. That is the tax. Strawberry Limited, a non-resident German company, has following incomes in India during the year ended 31st March 2025. Dividend income of 12,50,000 from XY Limited, an Indian company listed on a recognized stock exchange. Give me 1 second. So 12,50,000 is dividend income as per section 115A. We discussed in NR taxation revision also. Whatever the dividend income is there, on dividend income tax rate applicable is 20%. Next, 8% debentures of 20 lakh rupees received from X Limited, an Indian company, on October 1st, 2024 in consideration for providing technical know-how. See, I am providing technical know-how. I am getting consideration. Consideration is not received in cash. Consideration is non-monetary consideration. What is that non-monetary consideration? That non-monetary consideration is 8% debentures. So this 8% debentures is income on providing technical know-how. So we can consider 8% debentures as fees for technical services. So fees for technical services is 20 lakh rupees. So what is tax rate applicable for fees for technical services? On fees for technical services, tax rate applicable is normal tax rates. SD Limited, it is foreign company na. Sorry. Strawberry Limited, it is non-resident na. For non-resident, for foreign company, tax rate applicable is 35%. Next, dividend income of global depository receipts of Y Limited, an Indian company issued under a scheme of central government. We have discussed, if non-resident or foreign company purchases global depository receipts, on global depository receipts, if any interest income is paid, that interest income is taxable at 5%, and if any dividend income is paid, that dividend income is taxable at the rate of 10%. Business income, this is also taxable at normal tax rates. For foreign company, normal tax rate is 35%. Next, income by way of royalty amounting to 10 lakh rupees from Jed Limited, an Indian company. On royalty, tax rate applicable is 20%. As per DTAA, tax rate applicable is 22%. We have studied provisions of Income Tax Act, provisions of DTAA, whichever is beneficial to the SSC are applicable. Here, whichever is lower means 20%. So, on this royalty, tax rate applicable is 20%. Let me check, am I correct or not? 10 lakh rupees. Yeah, 20% correct. So this is all about model test paper 1. Thank you very much. We will meet again tomorrow with regard to model test paper Good night. Sir, please tell priority sections or concepts in NR taxation and assessment procedures. Surendra, in NR taxation, I have discussed in revision lecture, I discussed only taxation of NRI, taxation of non-residents. Please listen that revision lecture. In that revision lecture, whatever the sections that I have discussed, all those sections are important sections. Only important sections I have discussed in revision lecture. Whatever the procedural sections are there, I did not discuss. So please watch that revision lecture. Whatever the sections covered there, they are important. And assessment procedures also same. In revision lecture, whatever the sections that I covered only important sections. You can listen them. Okay. So yes, thank you very much. Bye. Good night.